Welcome back to our channel. My name is Aldo Lagrutta and I'm the founder of the Technical Analysis Institute. We are dedicated to help traders start and sustain successful, profitable careers without the frustrations and losses that are typically involved in the process. In this video, we'll cover the one thing that can make the RSIs be a magical indicator. It's so simple, so obvious, and yet so effective. This video is part of one of the modules in our Technical Analysis Mastery program, and you guessed, that module is dedicated to mastering the RSI. We'll cover one of the most orthodox entries of the RSI, namely the overbought and oversold conditions. I hope you enjoyed this video as much as we enjoy making it. Let's begin. Let's start with the top and bottom signals. The proper rules to trade using the top and bottom approach are simple. For selling, once the RSI has gone into the overbought conditions by crossing its upper reference line, sell when the RSI crosses back below it. That means you'll need to wait for the close of the bar so you can confirm that the RSI is indeed already below the 70 line. For buying, you need to wait for the RSI to become oversold by crossing the lower reference line and then buy when it crosses above it. Again, you need to wait for the bar to close before you can make sure that the RSI is already above the 30 line. Those would be the proper rules, but as we discussed in previous videos, this strategy is likely going to have more losers than winners. Why? Because by the time that the RSI turns, if it is not one of the good signals, prices will go against you immediately. But there is a way to make it better, and we are just going to see it right now because it is super simple. The best way to improve the top and bottom signals and increase the odds of success of this strategy is by using it in 2 time frames. What do I mean by that? Those of you who follow my trading system know that we use multiple time frames in our analysis that include the monthly, weekly, and daily charts. Beyond that, we use intraday charts to trigger our trade at the most optimal price levels. For shorter term trades, however, we use a variation of that. We use a strategy that I call the DFTS. It stands for Dual Frame Trading Strategy. Basically, you need 2 time frames separately by a factor of 5 or 6. One for trend reference and the smaller one to trigger the trade. This doesn't have to be precise, as I said, by 5 or 6, but it gives you an idea not to have too large of a separation between the reference chart and the trigger chart. And this is the way you would apply it. If your reference time frame shows an uptrend, then you can use the RSI in your trigger chart to buy once it goes below the lower reference line and crosses back above it. Conversely, if the reference chart shows a downtrend, you can use the RSI in your trigger chart to sell once the sell signal appears. That is, when prices move above the reference line and crosses it back below it. The way to determine the trend in the reference frame can take multiple forms, from moving averages to trend lines, wave counts, etc. Let's look at some examples. This is the 6-hour chart of the dollar index. After the decline, prices started to sport higher highs and higher lows. Once that a pivot high was formed, followed by another pivot low, we're able to draw an uptrend line that defines the trend as up. With that simple step in the 6-hour chart, we can move to a 60-minute time frame to look for buy signals with the RSI dropping below the 30 reference line and penetrating up from below. The next chart is an hourly chart, which I squeezed so you can still see the origin of the trend line and the RSI moving below the 30 reference line. This is a warning that a buy signal may be about to happen. And this is what happened only a few bars later. The buy signal is there. We can see prices are trading at around 102. Remember, the rules to buy are: first, wait for the RSI to become oversold by crossing the lower reference line, and second, buy when it crosses above it. Both elements are there, so we can place our buy signal around 102, and the results you can see on the next chart. You can see how prices started to move higher, continuing to produce higher highs and higher lows all the way to 102.80. At some point they needed to correct, and the RSI went all the way below the reference line, giving us the opportunity to add to the trade or buy again. Finally, you can see on this chart what happened. I'm using a 2-hour chart so you can see the entire move that was captured by these two signals. Notice that while this particular signal is not effective to capture tops and bottoms, it is indeed very effective to capture a large portion of the trend. Here's the good news. This type of setup is rather common and can be used with high efficacy. In summary, we analyze a trend on a 6-hour chart using the simplest tool to do so, that is a trend line. Once we define the trend as up, we move to a lower time frame, in this case an hourly chart, and waited for a buy signal to occur. Nothing complex and indeed extremely simple, but highly effective. Next, we'll explore the same strategy but using a different way to identify the trend. On this chart of crude oil, it's a 5-hour chart, we can see a typical double top formation. The two tops are clearly visible inside the pink rectangle, and the neckline has already been penetrated, thereby confirming the double top structure as in place. That establishes the trend direction now as clearly down. The question for us is, where do we enter? And the answer to this question is nicely given by the most typical RSI sell signal when we move to a smaller time frame by a factor of 5 or 6. Using this strategy, sometimes the time frame can even be lower than that. But for this example, let's just use an hourly chart and try to find a spot where the RSI goes above the 70 reference line and then comes back below it. That'll be our next sell signal, and one that we want to take given the fact that a clear double top pattern has identified the trend as down. The next chart shows the hourly chart with the RSI on it. Notice that at this point the RSI is oversold and ready to give a buy signal. However, that signal is meaningless for us. Why? Simply because we have established the trend as down using a double top pattern. Therefore, the only signal we are concerned with are sell signals on the trigger chart, if we get them, of course. In this case, we got a sell signal after several bars and a huge spike to the upside. However, at this point we're not concerned with the size of the spike. Our plan was to sell the next sell signal of the RSI and every sell signal thereafter. And here it is. A sell signal can be placed at around 84.20. In order to show you what ensued after the RSI sell signal, I have switched to a 3-hour chart where you can see the price drop from the 84.20 entry all the way down to 77. Notice that the signal was one of the simplest orthodox use of the RSI, that is to identify tops and bottoms or overbought and oversold. By now, I am sure you can see the value of the dual frame trading strategy using the RSI. Simply identify the trend in a larger time frame using trend lines, chart patterns, moving averages, Elliot waves, etc. You can even use candlestick patterns. For instance, using the same example we just saw on the double top formation in crude oil to determine the trend, we can instead, or even in addition to, use candlestick patterns. The first top had a potential dark cloud formation, where the red candle opened above the green one and closed below its midpoint. That was a significant blow to the bullish mentality witnessed during the large rally. And at that point, we already know the potential for a trend change from bullish to bearish. That was confirmed on the second top when prices produced a shooting star. So even without the break of the neckline, we can be already in the lookout for a sell signal in RSI using our trigger chart. In fact, Do notice how the RSI sell signal had already accompanied the dark cloud formation in the same time frame. As we move to the trigger chart, we can see that the hourly chart gave a sell signal right after the shooting star that formed the second top. The candlestick patterns, in combination with the RSI, were able to provide earlier entries. But that's not the conclusion that is most important here. What matters to us is that we can use any trend identification or trend change pattern on the reference frame and move to the trigger chart, where the RSI would provide us with amazingly highly effective entry. There is no question that using the DFTS as a way to improve the top and bottom RSI orthodox strategy results in high probability setups regardless the strategy you use to identify the trend. A veteran Elliottician, well aware of this fact, usually takes advantage of the top and bottom RSI strategy to enter on waves 2s, 4s, or B of a zigzag when the setup is present in a lower time frame. Let's look at one example. On this chart of Euro, we can see that the position of the RSI during intermediate wave 4 of the rally is not anywhere near the oversold territory. Now let's move to a 6-hour chart, where we can see that it was precisely at the bottom of intermediate wave 4 and also at the bottom of primary wave 2. It was there that the RSI offered the best oversold setup, in other words, the best buy signal. We invite the viewer to check the validity of this approach using Elliot Waves. You will be impressed how accurate and helpful this simple strategy can be for your wave count as well.